This week we're going to just jump right in to rates and yields. I think the point to make here, year to date, rates, par rates, all up. A few basis points, but still up. And our long end of the curve not doing very well. We got a few basis points year to date on the 20 and the 30, but up to the 10 is where they're meaningful. Mortgages based off the 10-year. Car loans typically based off the 5 or the 7-year. So that is the cost of consumer credit. More expensive year to date. We're 23 days into the month. Banking index, not a good week for the banking index. Year to date, not bad, 4.3%. The dollar just not doing very well. This can be laid at the feet of one man. Last week at this time, we're going to have Greenland, and we can do this the hard way or the easy way. And now we got Greenland at the cost of a lot of goodwill. And we got what we could have gotten had we just said, okay, this is what we want. You know, art of the deal. There's no point in making a deal unless you make a lot of enemies at the same time. Otherwise, you must have left something on the table. XLU down year to date, and that makes sense because it would be sensitive to the long end of the curve. IYR had a bad week, but still up for the year. Staples showing some life after having a terrible year last year. This is a defensive sector. I've added XLU this week. I didn't have it last week. That is also a defensive sector as well. 6.73, beating SPY, beating Triple Q, but not beating IWM. 8% year to date. What a month to be in small caps, right? Even TLT, look at this. Coming along for a little bit, and that would make sense because TLT's exposure is right in there. So if we do have year-to-date lower yields, it would, at the margin, begin to benefit TLT. Looking at ZQ, another week of, oh no. President Trump will not exert his influence on the Fed. Oh, sure, he'll do Greenland. Oh, sure, he'll threaten Canada. Oh, sure, he'll send the army into liberal cities. Oh, sure, he's a dictator in the wings waiting to be. But we all collectively draw the line at his influence over the Fed. Not gonna happen, says the market. So ZQ prices out more basis points. It is an uncomfortable trade to be in right now, but I'm not going to be wrong. I revisit it almost on a daily basis when I look at ZQ and I see that red ink on the screen. I think, okay, what am I missing? What am I missing here? What am I missing? You know, is the market thinking that he's not going to survive until that time? But here we are. We are firmly pricing in less than 2 rate cuts over the next 8 meetings, 5 of them under the new guy, which is, if we look at Kalshi, they're putting the weight, Polymarket putting the weight on Rick Reeder. Kalshi doing the same thing, pretty much neck and neck, 47 or 48%. Less than 2 rate cuts. We're not going to get one this week. And that's not a criticism saying, well, the Fed's behind the curve on this one. We got 3. I think it is time for a couple of meetings where, okay, let's just hang out here for a while. Let's see what happens. These things do work with a lag. Let's see what happens. So I wasn't expecting one this month anyways. I seem to think that there's one left under Powell. I've said that before. I seem to think there is, and if there is, I think in June you get another one. But if there isn't one under Powell, I think in June you get 2. I'm not looking for a June meeting and suddenly you're going to get 100 basis points of cuts. I don't think that you're going to get that done. I don't think anybody can get that done. But a good negotiator can go in there and say, look, you know, we got to buy ourselves some time. If we can give him something early, I think we buy ourselves a lot of time. Nobody here wants this in our lives. Let's just buy some time. And I think everybody might come along and say, well, okay. Not only that, I do believe the data will give them permission, number one. Number two, we're going to look at Japan this week. And I'm going to show you that their defense, it appeared that they defended the yen. Their defense of the yen is useless and senseless, because it only works if you can follow through, and they cannot follow through. And I think the U.S. is not far behind Japan in their ability not to follow through. They will have no choice, I think, given the fiscal situation, but to run to the zero line. But here we are, I think, in one of the most mispriced assets still, ZQ. It is quite amazing, and it's frustrating but easy to play, because the equity market gets all the good news and all the benefit of the doubt. You have some securities that are priced for absolute perfection. It's going to happen. Don't question it. Here you go. And then you have, on the bond market, all the bad news goes there, and there's no benefit of the doubt given to anything. It is like there's a gatekeeper saying, okay, let me look good. Okay, this is good news. You go this way. There's the equity market. Okay, this is bad news. You go over there to the bond market. Let's look at our choices. And I think this is the week that you would announce. This is the week that I would announce, because I know the Fed is not going to give me anything. So I'm going to want to take power away from them very quickly. So I can either announce Wednesday and compete with the Fed and take the cameras away from the Fed, because they'll certainly be on me. I'm Trump. They'll certainly be on me, and I could suck all the cameras towards me and shut down the coverage and make it background noise if I announce on Wednesday. Or I can wait for Wednesday, see if they cut, and if they don't, I can announce it on Thursday. So I seem to think that if you're going to announce, you got to know who it is by now. I mean, you have to know who it is, and there has to be a transition period where the new person has to unwind their current life to step into this new life. And you can't tell them on a Friday you start on Monday. By the way, I did have a job one time where it really was that. It was a Friday afternoon. It was, okay, you start on Monday. It's like, seriously? I'll make it happen, but seriously? So you got to give it some time, because there are, after this week, only 2 meetings left. Rick Reeder in the lead. Kevin Warsh down to 33. This was Deep Think's pick. And when I presented this, I said, let's not discount Rick Reeder. And the reason I had said that is because he is a market guy. He'll understand the trade, right? You have a bunch of other people with more academic background that will attempt to bring you over to their side by presenting their argument. Not a trader. A trader won't do that. I think Rick Reeder probably would be in a better situation mentally and psychologically to bring people over to his side, because he understands the market and is less inclined to rely on a data presentation of why they should vote the way he would like. Kevin Warsh sort of dropping off. This was Deep Think's choice, and at the time I said, let's not discount this. You have Rick Reeder rising. You have Besant, which is almost at 2%. Trump does want Besant. I think both of them could probably be confirmed. I don't know. This one here I'm torn on. I can see it going either way. So I'd almost put 50-50, not 47% and 2%. I'd say, well, there's no point in keeping these in here at all. And we do have to replace Mirren, and he does have to be replaced, because Mirren gets no respect. He's not going to convince anybody at all. And if you can put enough people in there, and they only have, their job is to only convince one other person, to convince one hawk. That's their job. Mirren is not going to get that job done. But yeah, if I had to bet, I don't know, is there a polymarket bet, not on who is going to win, but on what week they'll announce? Because I would bet this week. Looking at real yields and break-even, real yields all lower for the year. lower real yields, and we saw on the other screen a lower dollar is bullish for gold, and gold is showing it. Week over week, 8.6%, up 15% year to date. Silver making a mockery of capital markets, up 43% year to date, 15% last week, soaring past $100, turning the metals complex into a casino. Copper and aluminum, the industrial metals, behaving themselves, going up but behaving themselves. It's nice to see. Platinum and palladium also making a mockery of things. This is no longer a metals market. This is a casino. Our break-evens, and when you have nominal yields that are up and you have real yields that are down, it means the market is saying, oh my God, inflation, inflation, inflation. Look at that, 20 basis points year to date added to the 5-year break-even. Oil up a little bit, 6% year to date, but look at natural gas. When the storm last week started to become more and more and more of a reality, oh, it's going to happen, it's going to be a bad one, no, it's going to be a really bad one, no, it's the worst in 50 years, look at that. And it ran up, and then it was up like 30 cents one day. Then suddenly, a little while later, it was down like 11 cents. Then it was back up 20 cents. This thing is wild. It's a spectator sport. 70% in 1 week. If you understand futures contracts, they are not like stocks. It is a contract between two people. All futures are contracts between two parties. I shouldn't say people, but parties. A long side and a short side. Half the market in the futures space, half the market at any given time is short by definition. Half the market was short. Ouch! Look at that, 70% in a week. You don't hang on to that. This thing is volatile. I decided to play this market. I went out to April. There's got significant backwardation in natural gas right now. I went out to April, but pretty much it's all over. Nat gas sitting around $3.50. I sold an at-the-money call, 39 cents. I sold one because I'm not stupid. Just to say that I was in the game, 39 cents. Because there's a lot of nat gas. It's just right now there's a short-term spot market frenzy, which is going to pull the short end of the curve up. So let me just show you how that works. In typical markets, you have something called contango. The spot price is down here. The front month would be a price above it, and each month is slightly above it because the cost of carry, which is the financing and the storage, increase over time. The longer the time, the higher the cost of carry. But when you have a stressed spot market, the spot market just shoots right up and it starts to pull the curve up, so you get something that looks like this. You get backwardation. The longer dated contracts don't go up as much because this is stress in the spot market, and the market believes that in time that stress will take care of itself. Well, that's what I did. You have a market that the backwardation looks like this. It's incredible because the spot price just shot right up and pulled the front up. So I sat there saying, okay, well, that's $3.50. Let me sell the call. That gets me to $3.99. By the time we get to April, with record production of natural gas, I think we'll be below $3.50. Of course I think that, otherwise I never would have sold that call. But there I am at the casino table, putting all my chips on red. Let's see what happens. Let's look at OAS. Nothing to see here either. Spreads still contracting. Mortgage rate 6.09 will not print the 5 handle, and I think you're going to need a new Fed chair to get that done, and you're going to need some kind of policy to get that done. Mortgage apps for January 16th up 14.5%. So far for applications, January since the beginning of the year has been on fire. Pending home sales for December down 9.3%. FOMC meeting on Wednesday, and I believe we have Bank of Canada in the morning as well. We got 2 this week. And the weight, 97.2% is on nothing. Call that 100%. I agree with that. I think 100%. You got 3 in a row. We are not in a job market and an economy that says you need 4 in a row. Certainly the 3 matters. And I think in a couple of months you're going to need more cuts because there is some question as to whether or not that data is clean. The GDP data is clean. We'll get the last, or we've had the last look. We're going to not get first quarter GDP or fourth quarter GDP for a bit. And I don't think we get PCE at the end of the month either. So we're still trying to catch up on the data. But I think the jobs market is not going to be friendly. I think we do have a backdrop of deflation. And I think that the data that is being measured incorrectly with a lot of error, a lot of sampling error, a lot of imputed prices, and too much backward-looking stuff. I think that inflation is probably coming in lower than where the stated amount is. Powell's last stand, 70% probability on from here to then over 3 meetings, no cuts over 3 meetings. A small probability, 26%, that you'll get 25 basis points. I seem to think that should be more 50-50, but there we are. You're looking at a 97% probability of 0 or only 1 cut under Powell, up from 95.7%. Yes, Powell is an institutionalist, but he's not vengeful or hateful. He will follow the data. If the data tell him to cut, he will cut. He will not just say, fine, I'm going to show the president that I'm in charge here and we're not cutting at all. He's not going to play that baby game that Trump likes to play. This is June. This is Reader's first stand. Last week it was Warsh. Of course, I give it a question mark. Is it Reader now? Is it Warsh? Right? This is The Apprentice writ live, but with no payment for the producer. 85.8% probability of either 0 or only 1 cut. Basically a 45% probability on 1 cut. I would seem to think that if we had 100% probability of 0, you would have 100% probability of 25. Well, maybe not 100, but probably 50% here, 50% on the 25 and the 50, and that the 0 would be gone. The market is giving no benefit of the doubt that this administration can engineer a situation under which they're going to get rate cuts. No benefit of the doubt. Now, on execution, that probably makes sense. On policy, there's a lot that you could say with this administration. Yeah, I kind of agree with that. But when they execute their policy, it's a bloody shit show. They end up in worse situations than had they done nothing. So if we're looking at this and the market is saying, oh, sure, he's saying one thing and I'm sure he's going to try his best to get that done, but he can't execute. This group of clowns can't execute. Maybe that's what we're seeing here. 83%. Last week is 85, almost 86% this week, which is just a little under 97%, that 0 or 1. Is my ZQ trade in trouble? All right. Reverse repos under $1 billion. Call it 0. Repos 0. Reserves sitting right around $3 trillion, and the TGA still about 100 billion higher than it needs to be. This will probably head down by the time we look at May. The TGA will probably be under their target of 750 because they have all of the no tax on tips happening this year, and all of the withholdings were reflecting the higher tax rates. So they're going to be issuing a lot of tax refunds. And government shutdown, as I said last week, I don't think either side has the appetite for another shutdown. It appears that it's averted, for now. There's still plenty of camera time left, and politician is not going to waste camera time. You got to peacock for the cameras. So that when you're running again, you got to say, I was the only one who voted for this. I was the only one who said this. I did this. It's all about them. Let us look at our economic calendar this week. We also have an earnings calendar, which is fairly thick this week. And then, of course, you have the Truth Social calendar of what is this guy going to say? When is he going to say it? And how outrageous is it? The more that there is a focus on a problem, the more crazy the stuff will be. You had another shooting in Minneapolis. You got to take eyes off of that. I would look for something crazy, and it just might be Canada. We'll have a look at what the little beta baby is crying about this time. Monday, durable goods for the U.S., 8:30. I don't know that that's going to really move markets very much at all. Everyone's got their eyes on earnings. Everyone's got their eyes on the Fed and who the new Fed chair will be. Some house pricing index or house pricing on Tuesday. And we have the Bank of Canada at 9:45 and followed by the Fed at 2 p.m., the press conference at 2:30. Again, what's he going to say? What's he going to say? I'm going to mention this. This is foreign bond investment, and you get this number every single week. Last week, negative $361 billion. That is divesting of foreign bonds. Is that a footprint? Thursday, exports and imports. This is still backwards looking stuff. This is for November. We still don't have December. You have our initial jobless claims still coming out. Still running low. Non-farm productivity, unit labor costs, last look. This is the final look for Q3. Unit labor costs, negative 2.9. That is deflation. Right there. That is what productivity will do. For productivity, 4.1, resulting in negative 2.9 on your unit costs. And going into Friday, for December, this is usually you have it earlier than this, but we'll take it. You have PPI going into Friday, but we don't have PCE. For Canada, we have GDP for November and our preliminary look at December GDP. And then, of course, at any given time, you have the orange dictator. So there's no schedule for that. Okay, let's go to Davos first, and we're going to review Mark Carney's speech because a lot of, I think, important things were said in it, and it was well received, standing ovation, extremely rare at Davos, which means it was heard, and I think that it will begin to resonate. I highlighted some parts. Beyond the pleasantries at the beginning. Let me just get rid of this here. It starts off pretty bold. First paragraph. Today I'll talk about the rupture in the world order, the end of a nice story, the beginning of a brutal reality where geopolitics among the great powers is not subject to any constraints, the end of a nice story, the beginning of a brutal reality. Other countries, middle powers, are not powerless. We live in an era of great power rivalry. Rules-based order is fading. The strong do what they can. Weak suffer what they must. Strong tendency for countries to go along to get along, to accommodate, to avoid trouble, to hope that compliance will buy safety. Then I added the emphasis on the next short sentence. It won't. And he's right, because Trump is never done with you. His deals that he signs are not worth the paper they're written on, because he'll just rip them up at whatever his whim is. If you don't compliment him enough, if you go your own way, if you make any kind of comment, you get tariffs and you get tariffs and this is over. To accommodate, to avoid trouble, to hope that compliance will buy safety, it won't. Europe had the idea that we made these and I'm air quoting over here, trade deals with the Mad King. And now he's threatening to hit us with tariffs again unless we give him something. Why? Because you showed weakness, and this is what the bully looks for. The bully steals your lunch money because the bully stole your lunch money yesterday. And the bully will steal your lunch money tomorrow until you punch the bully in the face. Now, you might get your ass kicked, but the bully won't come back to you the next day because the bully doesn't want to fight. Bully can beat you up, but doesn't want to fight. Wants fear, wants submission, wants you to just hand it over. And if you do, it's not just that day. You have to know that. And that's Trump. He is a bully. He will just keep coming back and extracting more and more and more. Hope that compliance will buy safety. It won't. This is the example. I gave this nice story. Borrowed, but it is a good story about the greengrocer putting the sign in the window, "Workers of the world unite." He does not believe it. No one believes it. But he places the sign anyway to avoid trouble, to signal compliance, to get along. It's time for companies and countries to take their signs down. It's time for people to say the emperor has no clothes. We knew the story, and I like this part, because he doesn't just praise the way things used to be and say, listen, we're a people of rules, we get along, we're this, we're that. He's under no illusion that we live in a world of should. He's under no illusion that the world is perfect. Well, you know, when you had Biden, sort of chastising the population, our diversity is our strength. No, it's not. Right? I mean, you at least wanted him to acknowledge that too much diversity is destabilizing. This is what Trudeau did. This is what Biden did. And it does diminish the stability of society. Carney nods to that. We knew the story of the international rules-based order was partially false. That the strongest would exempt themselves when convenient. We have seen that many times with the U.S., willing to change the rules of the game when it suited them. The trade rules were enforced asymmetrically. International law applied with varying rigor depending on the identity of the accused or the victim. So even that, he said, we knew that was a lie as well. This is giving a nod to the idea that there is no optimal solution in complex systems, and the global order is a complex system, society is a complex system. There is no such thing as an optimal solution. There are only trade-offs. So whenever anybody says, oh, but look at the faults, yeah, it's a bad system, except for all the others. It's a bad system. There will always be trade-offs, always. So we want to try to minimize the negatives from the trade-off, maximize the benefit for everyone. That doesn't mean that everybody wins. So it's a cheap attack to say, oh, capitalism produces poverty, or that the rules order doesn't work because the strong will just change the rules when they want. Yes, and that's what Carney is saying. He's under no illusion that the old system was perfect. But he does recognize that in a complex system, all you have are trade-offs. And you can maximize, but you cannot optimize. Let me be direct. We are in the midst of a rupture, not a transition. Risk of extreme global integration. Great powers began using economic integration as weapons, tariffs as leverage, financial infrastructure as coercion, supply chains as vulnerabilities to be exploited. That is also looking at China. A little nod there because they do have a lot of capacity when it comes to processing of rare earths. Also a nod towards the U.S. in restricting access to certain types of technology for China. Supply chains as vulnerabilities to be exploited. You cannot live within the lie. This is a beautiful sentence, by the way. You read this and you wish you wrote it yourself because it's such a beautiful sentence. You cannot live within the lie of mutual benefit through integration when integration becomes the source of your subordination. Beautiful. When the rules no longer protect you, you must protect yourself. But let us be clear-eyed about where this leads. A world of fortresses will be poorer, more fragile, and less sustainable. And there is another truth. If great powers abandon even the pretense of rules and values for the unhindered pursuit of their power and interests, the gains from transactionalism become harder to replicate. Hegemons cannot continually monetize their relationships. I wonder who that was directed towards. Transactionalism cannot continually monetize their relationships. Allies will diversify. This line here, you can really see his Goldman Sachs pedigree here in just the language that he chooses. Keep in mind, ex-Goldman Sachs, ex-central banker in Canada, ex-central banker in the UK. This guy knows markets. This guy knows economics way better, I think, than almost any world leader. You can really see the Goldman Sachs language here. Allies will diversify to hedge against uncertainty, buy insurance, increase options. That's a market guy. This rebuilds sovereignty, increasingly anchored in the ability to withstand pressure. The question for middle powers is not whether to adapt. We must. The question is whether we can do something more ambitious. We actively take on the world as it is, not wait for the world as we wish it to be. I have somebody who works for me who always uses the word should. People shouldn't behave that way. People should be like this, and you shouldn't even do that. And why would people behave that way? I have to say, stop. You cannot describe the world as it should be. We don't live in a world of should. We live in a world of is. It's not helpful. Yes, people shouldn't kill each other, but they do. Yes, there shouldn't be rape, but there is. You have to describe the world as it is, not as it should be. Live for a world that should be. Act in that way, but recognize that we live in a world of is. And this is what he's doing here. We actively take on the world as it is, not wait for the world we wish to be. We had this feeling under Biden and Trudeau that they were living in a world of should, and not describing the world as it was, and just ignoring the reality of everything falling apart around them because they just kept thinking and describing the world as it should be. Not him. This is from a liberal, by the way. This is from a liberal. But in the center, middle powers must act together, because if you are not at the table, you are on the menu. When we only negotiate bilaterally with a hegemon, we negotiate from weakness. We accept what is offered. We compete with each other to be the most accommodating. That sounds familiar over the last year, right? This is not sovereignty. It is the performance of sovereignty while accepting subordination. Another beautiful sentence. What would it mean for middle powers to live in truth? It means naming reality. Stop invoking the rules-based international order as though it still functions as advertised. Call the system what it is. A period of intensifying great power rivalry where the most powerful pursue their interests using economic integration as a weapon of coercion. It means acting consistently. It means building what we claim to believe in. And it means reducing the leverage that enables coercion. We are taking the sign out of the window. The old order is not coming back. We should not mourn it. Nostalgia is not a strategy. More beautiful words. And that's it. If you haven't had the privilege of reading this speech, I strongly recommend that you do. It's online and available for download. I've just copied it into Word so that I could highlight it. I do think this is one that will be almost required reading in political science classes in the future. Needless to say, this did not please the king. The week before, when it was pointed out that Mark Carney was in China to cement some deals, and Trump said, that's fine, that's what he should do. If you can make a deal with China, go ahead. And then after this speech, if Governor Carney thinks he's going to make Canada a drop-off port for China to send goods and products into the United States, he is sorely mistaken. Well, that's not what he was thinking. China will eat Canada alive, completely devour it, including the destruction of their businesses, social fabric, and general way of life. If Canada makes a deal with China, it will immediately be hit with 100% tariff against all Canadian goods and products coming into the USA. Thank you for attention to this matter, Premier Donald J. Trump. I say Premier because I do agree that North America as a whole would be stronger if it were just one country. I do think that has some benefit. You don't have to worry about allies. It's just one big country. But I think that it would be better if the U.S. were admitted into Canada as our fourth territory. Not quite a province yet, but as our fourth territory. That would elevate Trump to the title of Premier. Premier Donald J. Trump. And of course, no reply, so we had to keep going. The last thing the world needs is to have China take over Canada. China is taking over Canada now. Wasn't China and Russia going to take over Greenland? Can't let that happen. It's not going to happen or even come close to happening. Thank you for attention to this matter, Premier Donald J. Trump. So the orange beta baby strikes again. I say beta because he is a beta. He only plays an alpha on television. He is strong with the weak, like all bullies are, but weak with the strong. If you stand up against him, the bully backs off. That's a beta. That's not an alpha. So here we are. I did say this about the Venezuelan oil. If you go back a couple of weeks when that was the issue, that what it appears that could happen here is Canada sends a lot of a particular type of oil to the U.S. The Venezuelan oil could substitute for that. So this might be a way to cripple Canada by using Venezuelan oil. In that case, we can always sell our oil to China. But if we do, and I said this, if we do, the U.S. would blockade our ports right away. In a heartbeat, the U.S. would put a blockade up and no, you're not selling your oil to China. And here we are. He's easy to predict. He's easy to play. He's now saying, okay, Greenland. The Russians and Chinese were about to invade Greenland. Not gonna let that happen. And now, China's gonna take over Canada. It's not going to happen. All in caps. Not going to happen or even come close to happening. This is a one-trick pony. What's he got? Threat, tariff, threat, tariff. He's a one-trick pony. A one-trick pony. And here he is crying in his crib like a little orange beta baby. You know how hard it was to get either Gemini or OpenAI to give you a picture like this? How difficult. Try to get them to do anything that makes fun of a leader, or gives a picture of a leader that people would look at and say, yeah, that's exactly how he's acting. You've got to sneak up on it. Give me a picture of a baby crying in a crib. Then it starts and stops and says, we have a policy against nudity with children. I said, who said anything about nudity? Dress it up. I don't care. Give it a onesie. I never said anything about nudity. You did. Oh, you're right. Sorry about that. So it gives you a baby. Then you say, well, it's crying, so give it a stained shirt like it dropped some of its food on its shirt. And so it gives you that. And then it's like, well, let's give it some hair. And you couldn't say Trump hair. You had to describe the hair. And it took forever to describe the hair. So I took a picture of Trump and I just put it in a sketchbook and I erased everything else but the hair. And I said, here's a wig I found in a Halloween store. It would be funny to put this on the baby, and you can get it done if you got to sneak up on it though. But if you ask for a picture of Trump in any kind of way, no, we won't do that. The AIs are not stupid. They are afraid of the dictator as well. But you had to sneak up on the AI to get this done. So what does this all mean? Carney did not answer back, and I think that's the right move, is don't have a leader respond. Have somebody lower respond, because that sends a message on its own that you are not important enough for my time. That sends an important message when you have somebody lower in the structure replying to you. You're not going to kowtow to this one. So we had a reply that, don't worry, US, we are not signing a free trade agreement with China. You're our trading partner if you want to be, and we'll keep it that way. All we did in China was settle some old tariff issues that we had. That's all we did. It wasn't an agreement or a free trade agreement. It was just they had tariffs on us, and we went over there and we said, look, do you really need to have the tariffs on us? And we just solved a problem. That's all. By the way, I don't think any of this helps Trump with the Supreme Court, because this is showing that tariffs are not a function of national emergency, but tariffs are an inverse function of the thickness of dear leader's skin. If he doesn't like what you say, you get tariffs. If he likes what you say, you get lower tariffs. That doesn't sound like a national emergency. Canada, I think, is set to do very well over the next 15 years because we are a resource superpower. Name a resource, we have it. What we don't have, which is, I think, to Canada's detriment, is a lot of processing capacity. We take our minerals and we send them somewhere else to be processed. We take our timber, we have sawmills, but for the most part, we export a lot of just timber itself. You cut the tree down, you put it in a ship, you send it to Vietnam, and then they cut it up. We send a lot of oil to the US, and then we buy a lot of gasoline in return. We don't have a lot of processing capacity here in Canada, to our detriment, but for resources, we are resource rich. Mexico, on the other hand, is labor cheap. Lots of cheap labor, and that was the idea behind the free trade agreement, is the US said, hey, wait a minute here. What if we took all the raw materials from Canada, which we don't have, many of them, and we sent it down to Mexico and have it made really cheap because, well, we don't have that cheap labor. Our consumers are going to really win on this. Right? That was the whole idea behind that trade structure. We can sell our product anywhere, by the way. And it would be interesting to see how you're going to get a 100% tariff done, especially on uranium, when Canadian uranium supplies, some 37 nuclear facilities in the U.S.? You can double the price of that. The proper way of saying this is, if you continue on this path, we will charge our citizens double for anything they want to buy from Canada. How do you like that? Okay, let's have a look at the yen. If you were watching the yen on Friday, if you looked early in the morning after the BOJ decision, you thought, that didn't really do too much. And if you went about your day and came back a little later on, you would have been, what the hell just happened? And the Bank of Japan does have, I think, a sort of line in the sand around 160 where they tend to intervene. You would look at that and say, well, that looks like intervention, but a few other things going on at the same time. Intervention, by the way, doesn't work as a one-off. You either have to keep intervening, or you have to have something changing that forces the market to recognize that the weak yen is unjustified. You have to have some kind of fundamentals that are changing, and that would be the threat of higher interest rates. That is a hollow threat coming from Japan, I think. I don't know that they have the appetite for 1%, 1.5%, 2%, 3%, 4% that would be necessary to strengthen that yen. I don't think they have the appetite for it, simply because they have a level of debt that they simply could not afford. They have no choice. They've painted themselves into a corner, and all they can do is shake their fist at the market every now and then, and they must intervene. They must. But it is unsustainable. Now, they can continue it for quite a long time. They do have enough resources, or reserves, to continue this for a long time, but continue it you must. This will reverse. Because it has to be supported by some underlying fundamentals that force the market to move in that direction on its own. You're not going to defend 160 for long. I think the defense before used to be around 140, and now it's retreated to the 160. I think it's inevitable. It retreats to the 180, then the 200. But let's sort of break this down. Let's start with the data. Inflation rate for December, 2.1. Previous reading was 2.9, so that is down. Core inflation, 2.4. The expectation was for 2.4. Came in as expected. Previous reading was 3%. That's coming down. Month over month, the inflation rate for December, negative 0.1. That is deflation. This is what Japan had fought against for years, was the specter of deflation. There it is. Look at their PMIs, 51.5. Like, you know, it's not as if your PMIs are weaker and weaker and weaker and inflation is just inching down. You have PMIs that are increasing and inflation levels are coming down. You know, that tells you something about the underlying price pressure there. That had you had PMIs that were not increasing, this deflation would have been worse. 51.5, previous reading was 50, even beat the expectation. This is manufacturing. You look at services, previous reading 51.6, we're 53.4. So the composite, which is the combination of manufacturing service, 52.8 over 51. PMIs all came in stronger. Interest rate decision unchanged. Nobody thought it would change. And initially, not much happened. Initially, the yen weakened. And then it stabilized. This is looking at, just to give you the sheer impact of this, I'm looking at a 3-month, we're looking at a 3-month chart going all the way back to, a 1-month chart going all the way back to December, late December. If you look at the daily chart, it then stabilized for a while, and only around 11:15 did it begin to drop, and it strengthened significantly. 269 pips on this one, but since it uses just 2 decimal places here, or 3 decimal places, 2.69. So it's a matter of, well, they must have intervened. That is the thought, is that they must have intervened. The finance minister, Karayama, did say, we are watching FX with a sense of urgency. Sort of gives you the idea, well, okay, that's what they did. And we had this footprint a little earlier as well. Foreign bond investment ending the week of January 17th, down 361.4 billion yen. That's about 2.3 billion US, which is about the size of an intervention. So if you look at this without any more data, you'd say, well, look at this. You have, perhaps they were getting some US dollars ready to intervene in the currency. It has all the footprints of an intervention. You have somebody saying, we're watching this with a sense of urgency. That's clearly what happened. New York Fed reportedly, I put that in quotes, conducted rate checks midday around 11:15, looking at market depth, just trying to assess how deep that market was. And this is private, by the way. When the New York Fed calls specific banks to do any rate checks, that's supposed to be quiet stuff. That's not public. But they're smart enough to know that, hey, if we just call around and do this, word will get out. We don't actually need money to intervene. We just need the specter of intervention, and the weak hands will do it for us. Japan, when asked about this, 2 different people in the government asked about this. No comment. They didn't confirm or deny it. No comment. Neither did the New York Fed confirm or deny. No comment. So intervention, or the fear of intervention, but this rarely holds. It has to be backed up by policy, which means that the market has to believe that short rate is going to increase, that you're going to go from 0.75 to 1% to 1.25 to 1.5, that it's going to increase, and yields and rates are going to go up, because that's what's going to unwind a big carry trade, is the fear of a strengthening yen. You unwind your trade. That's your biggest risk, because you borrow at a money market rate in Japan and you invest at a money market rate somewhere else. You don't want any duration risk on either side of that. You only want FX risk. And you can't hedge that out. Otherwise, you lose the very interest rate differential you went in to get. So you want to borrow in a currency at a low rate, but also in a currency that you feel has no reason to strengthen. A central bank threatening to raise rates, well, that will do it. So what did they do? If you look at what they put out, they did raise their inflation expectation, the lower end of the bound. So they had a range, and they raised the lower end, but not the upper end. Upper end still at 2%, but they raised the lower end, I think, from 1.6 to 1.9, and reiterated they would raise rates if their projection materialized. So they raised their expectation for inflation, then said, hey, if this happens, we're going to raise our rates, hoping the market would step in. Bank of Japan did that. The yen initially weakened, then it stabilized. They looked at that and they said, he's no good. So then they had to do something further, which was either intervention or, well, what if we poker played this? What if we just bluffed our way through? That only works once, maybe twice. Now, you can intervene 3, 4, 5 times, as many times as you want, but unless the underlying situation changes, you're going to have to keep intervening. I don't believe them, and I don't think the market believes them. I don't think that they have much appetite for much more beyond 0.75 because the sheer amount of their debt. Now, they can print all the money they want because, of course, they control the printing press, and most of the bonds are held domestically, so that's not so bad. But they have done that. They've done that for a long time. They have a shrinking population and are facing more deflation than inflation in their future, unless they allow immigration, which they're not going to do. So this is something the market simply isn't going to believe them on, that no matter what they say about rates, no matter how much they want to defend the yen, they've painted themselves into a corner. They have too much debt. Let's jump all the way across the ocean to the U.S. They're on the same path. No one believes that the fiscal is going to clean up their own house. You have a political system in the U.S. now that is dependent on deficit spending. Each party is going to do what they can to get reelected. It's party before country. Both sides do this. No one lost an election, as Mitch McConnell says, by spending too much money. So they're going to keep doing it. So that deficit's only going to get bigger, period. And now we keep hearing Powell is an institutionalist. He's going to stick around to protect the integrity of the institution. If he were an institutionalist, the biggest institution is the United States of America. And if you cannot count on the fiscal to fix that problem, the monetary has to do the heavy lifting. Inflation be damned, you have a looming credit problem. It's a credit problem, not a credit crisis. If you want to see inflation like you've never seen before, get a credit crisis. There is little choice here, people. You have a deficit from last year that is bigger than expected and more likely to continue on. It is highly likely that by the time you get to the end of the official Trump term, I say official because there is some question whether or not it's even going to matter. But you get to the end of the official term, 2028, you could be looking at not $40 trillion, which you're knocking at $40 trillion door anyways, $50 trillion. That is becoming more than just a problem. You are inching closer to crisis. If you can't control the spending, you have to control the cost of the spending. That there is not any more conversation of this should be terrifying to every American. Because this is a race car heading for the side of a cliff with no one paying attention. No one. Let's just say it has no brake pedal. It has no brake pedal. So Japan is a good example of where the U.S. is headed right now, where all they can do is threaten. And it may work. You can win a poker hand every now and then by bluffing, but you also every so often have to have the cards in your hand. I don't think the Japanese have the cards in their hand, and you have a prime minister now who wants another election, who does believe that the fiscal should have more say over the monetary. Sound familiar? Who else thinks that the fiscal should have more say over the monetary? Because the monetary has now become a fiscal issue. The monetary is now absolutely essential to the performance of the government, not the other way around. I don't see how the U.S. has a choice. Now, they can wait, and there's a lot of evidence that suggests that's what the U.S. does. No crisis is ever averted. It's just talked away. Oh, somebody will take care of it. Oh, that'll never happen. Oh, it'll be contained. Oh, it's not really a big problem. There's always a cadre of people who will talk you out of the fact that it's a problem, and there's no reason to act today. Especially when it comes to markets, it seems that Americans really only respond when shit does hit the fan. Shit could be halfway to the fan. It's like, somebody will catch it. It'll never actually hit the fan, will it? We can't allow it to hit the fan. Somebody will fix that. But it does hit the fan. Will the U.S. act before this hits the fan? Because it is heading straight there. It is inevitable. I think this is a good case study for where the U.S. is headed. And I think that they could probably avoid a lot of issues right now if they did one thing: lower interest expense. Now, if you say, well, that'll only embolden them to spend more, they don't need a reason to spend more. They're going to spend more no matter what. Rates are high, they spend money. Economy's doing strong, they spend money. Economy is weak, they spend money. Rates are weak, it's uncorrelated. Fiscal spending, government spending of taxpayer dollars is uncorrelated with anything else. It is correlated with their desire to hold on to power. And that's a function of it. That's it. There is no choice. This is part of my ZQ bet. They're already on the path, on the Japan path. There is no choice. Now, Japan doesn't want immigrants. Wants Japan for the Japanese, doesn't want immigrants, and has a shrinking population. Well, does that sound like the U.S. over the last year? So I do think that whoever is put in charge of the Fed is probably going to have a very tight relationship with the Treasury. So that team is going to be absolutely important. And with that, I think that will bring the monetary closer to the fiscal, and there'll have to be some coordination, because I'm telling you, the U.S. simply can't afford to keep going down this path. You can either stop it now or wait until it becomes a full-blown crisis. But if you want to see inflation, well, then let's all just stick around and wait till it becomes a full-blown crisis. Okay, let's have a look at SPY. Still, the all-time high was January 8th, 694.48. We're just less than 1% below that all-time high. I have the level of the 50-day, the 100-day, and the 200-day moving average here. Forward four-quarter operating earnings 311, closing SPX 69.15, sitting at 22.17 times forward earnings. Market last week was 22.18, and we do have some volatility in here in terms of its percentile. Last reading 12.7. Small caps actually did quite well. January 22nd, IWM hit an all-time high, 270, pulled back to 264. Did not have a good Friday, an ugly Friday, down 2% from its all-time high. IJR, January 22nd, also all-time high here, 130.47. Ended at 128.09, down 1.82. And Triple Q still has not made another all-time high all the way back to October. Sitting at 622, down 2% below its all-time high. I don't think we are done with our bull market. The AI trade, I think, is a very real trade. I think we do have a shift this year to more efficiency from effectiveness, but that doesn't mean the capital spend goes negative or dries up. AI is not going away. I heard somebody say, if you take away AI, the market is weak. Yeah, but you can't, and it's not going away. So that's a silly thing to say, if you take away AI. We are, I think, early in this process, and there is a long tail of product still left to see, a long tail of revenue still left to see, and as far as metals go, we are in a commodity super cycle because we have had underinvestment for a long period of time, and I do think we are entering into a war, but a resource war, where we'll line up on two sides of metals and energy. So I think the volatility that we get right now is timing alpha, which means you buy on red days. And yeah, it does take courage when you see the market down 2% because of a country threatening to invade another country. We could do this the easy way or the hard way. It does take courage to step in and buy on red days, but this is what we have to do for a while now, is you buy on red days, you sell on green days. So last week, if you were on Discord, I post my trades on Discord, you will see that on those red days, I was adding delta. And on the green days, this is where you reduce your delta. I just haven't gotten any really good green days to do that yet. We do have earnings coming up this week, 102 companies, based on the information given to me by LSEG. I'm not fact-checking any of this. I'm just telling you what I read somewhere else. So let's go read that stuff we see somewhere else, and it may be right, it may be wrong. Okay, let's have a look at our S&P 500 earnings calendar. This is just the S&P 500. There are companies that report that are mid-cap, small-cap all week long. Hundreds of companies. I'm just showing you S&P 500. Nothing too much exciting on Monday. I don't really follow many of these. We do have a home builder in here. Let's head over to Tuesday, and this is UPS. That's all before the bell here. General Motors, they've had quite a run, and they have already announced a big hit to Q4 because of their backing away from EVs. It's a matter of how much more is in the future that still need to be written down. Boeing, NextEra, the largest utility in the U.S., and them and Duke share Florida. And then you have UPS. After the bell, Boston Properties. I do have exposure to Boston Properties. Texas Instrument as well. They didn't really impress last time, and it was a nice buying opportunity. So let's see if it gives me a buying opportunity. I'm probably not going to play the earnings, but if there's weakness on Texas Instrument and I see low 170s again, I'm going to step in. And then Seagate, where you have Seagate, you have Western Digital, so I'm sure we'll see that a little later. Seagate, Western Digital, and I think SanDisk is this week as well. Three of these big vol stocks, they have moved a lot, especially SanDisk. Well, they now have to sing this week, and let's see if they sing the same tune as the market. Going into, what do we have, Wednesday, and let's just cut it off here. This is before the market. We have Starbucks, GE Verona. They have been on fire for a while, right? AT&T, when we have AT&T, Verizon isn't too far away. After the bell, now, I want you to put Wednesday into context. You got the Bank of Canada in the morning, you got the Fed in the afternoon, you have the potential for the White House to mess all that up with their introduction. And after the bell, in case you think it's over, you have Apple, we have Meta, we have Microsoft, and Tesla. 4 big ones. And let's not upset IBM. 5 big ones. Let's, just in case they decide to come after me for not saying that they're one of the big ones. Going into Thursday, where does our morning end? Ends down here. Everything above is before the bell opens. CAT. I think their guidance will be good. They do very well with mining stocks. And if we are going into a nice strong super cycle, CAT will benefit greatly from that. Who else have we got here? Lockheed Martin, Southwest Airlines, MasterCard, where there's MasterCard. Visa's not too far away. Norfolk Southern, Pulte, we got a home builder in here. Sherwin-Williams, in the chemical space. Watch Sherwin-Williams. Their earnings matter a lot because there is something called the white paint index. The more white paint you sell, the more it signals that construction is on the upswing. Although we don't see that in the numbers, maybe it's in the paint. After the bell, there's Visa, there's Western Digital. There we go. There's SanDisk down here. And let's go into Friday. There's Verizon, where there's AT&T, where there's Verizon, there's American Express. Anything else interesting? Chevron and Exxon. And Fridays, they're always before the bell. You get somebody reporting Friday after the bell, that's because they're shit they don't want you to react to until Monday. Our spotlight company this week is Sunrun. This was a company that was introduced. We have on Discord, we have a Costa Rica chat room. Everyone who's been in Costa Rica. And one of the participants brought this up, 4 months ago, 3-4 months ago. And I started looking into it, and I think, it's a kind of an interesting company. It is not what you think it is. We think that this is a residential solar company. It is not. It is a specialty finance company that sells a lot of ABS or produces a lot of asset-backed securities backed by solar assets. But it derives its revenue not necessarily from rooftop solar, but from the financing aspect of rooftop solar and a few other things as well. So the best way to value this company is sum of the parts, and we will do a valuation as we go through. But I do want you to understand the nature of the business that it's in. It has a current market cap right now of $4.52 billion, using very conservative sum of the parts. In fact, almost negative sum of the parts. I get to about $6 billion or 26 a share. It is sitting at $19.43 right now. So even a terrible case, I get to 25% higher price. And if I go really negative, I basically get to almost this price now, $19.43, which means in a really bad outcome, you'd be paying fair value. In a really bad outcome. So you got a lot of optionality for outside. On a bullish case, and here you're going to need a lot of regulatory backing to get this, which we're not there. But that doesn't mean that we can't get there at the state level, but certainly not at the federal level. 56 a share. It used to be much higher. Go back to 2020 in their heydays, they were $80, $85 a share. For the last 3 months here, basically they've been running in this support resistance channel between 17 and about $20. But if you do a 3-year chart, the resistance line goes back a good 3 years. It has been trying to fight to get above and hold above $20. Doesn't pay a dividend. Will respond to lower rates. Think about a mortgage REIT. This will respond the same way. It'll respond to lower effective federal funds rate because it does use something called warehousing credit. Warehousing means if you're doing asset-backed stuff, you need to bundle up a whole bunch of solar installations, a whole bunch of them. And then you can sell bonds against this. That becomes an asset-backed security. But you got to put them in here. You got to get these first. So they got to sit on your balance sheet first before you have enough of them to sell. Well, you're going to need some kind of credit to be able to finance that. That's called warehouse financing, and that comes with floating rates. So the lower the effective federal funds rate, the lower their cost of warehousing credit. And they would respond very well to a bull flattener because that would lower their discount rate, because when they install a solar panel, they create a 20-year receivable. And of course, they find the present value of that particular receivable. You need a discount rate. You get a nice, massive bull flattener on the long end of the curve. The present value of all of that increases. So in essence, if you look at their business, they really are a balance sheet business and will respond to changes in rates and to changes in yields. I have been making money on this for some time, because every time they approach the lower end of this bound, I sell puts, $17.50 or $17 puts, 50 at a time. And I've never had them assigned to me. So I went more to the upper end of the channel. This time I sold $19 puts for February. This was a couple of weeks back. I got $2.50 for them. IV is very high, 76.5%. You can't let that go. You may say, but that is a dangerous level of IV. It's also a safe level of IV if you know how to use the options to hedge. You're getting paid a lot of money to get that done. I've drawn a line at 100% IV, and I know that the line is hard to see, but all this period of time, IV was over 100%, and it peaked over 100% here. At over 100%, you almost have to play this at 100%. My theta per day right now is 135 on this one. I've got the options chain up here. Here's the 19. There's your theta over here, negative 0.027. So that position makes 135 a day just on theta decay. These are now 115 and 136, probably about 125 I could close them, but I have no desire to close these. This is February 20th, 25 days to expiration. It'll be 25 days as of January 26th. Current price 1943, and at the money straddle, this is the closing prices. Now the spreads are wide because I took this after hours, so they do widen up a bit. But if you take the midpoint of the 1950 straddle, the straddle is 15% of the price. A decent, fundamentally good stock usually has very low IV. Usually you can get about 6 to 7% of the price out of the straddle. So I look at the price of the straddle as sort of an indication of the profitability of the premiums. I've seen some as high as 30%, 40% of the price of the straddle. You almost have to play it because the vol is so high. You say, look, I'm not going to play the price, but I'm absolutely going to grab this volatility. 76.5, it has been coming down because its fundamentals are fairly solid, but we'll understand when we see its guidance why its volatility is so high, because it doesn't have tight guidance. When it says, what's your cash flow or your cash increase going to be for the year? Oh, between 100 million and 400 million. Really? You can't tighten that up a bit? Between 100 and 300 or 100 and 400? Okay. So there's a lot of volatility in this. You almost have to play it. Let's try to understand what rooftop solar businesses do. Okay, we're going to start here, just sort of understanding the regulatory landscape of rooftop solar and how it has shifted with one big beautiful bill, and especially with a big trend in compensation for households that use solar, from net metering to net billing. And they do make a good argument of why it should be net billing. Let's start there at state level compensation. Net metering means that if your solar panels produce 1 kilowatt hour, you can offset 1 kilowatt hour off of your utility bill. So it nets out at the meter. Net billing nets out at the cost. If you produce 1 kilowatt hour of electricity to sell to the grid would then say, but our wholesale cost is this. Not what you pay, not at the meter, but our wholesale cost. So you should only get the wholesale cost of it. And the argument flows like this. If we offset the full kilowatt hour, you are not compensating society for the cost of the grid, of which you still benefit from. So you should really only be offset for the cost of the energy that you use, but because all these power lines still run to your house, and if you run out of power, you're still going to draw upon the utility. You're still using all of the infrastructure, so you should pay at least for that. In Costa Rica, if I put solar panels on my house, I must still pay roughly about 75% of the utility bill I would have paid anyways. So in Costa Rica, there is no payback period that makes sense. None. You must still pay the utility. And that is what's happening, is that you cannot go completely off-grid because the argument is, well, what about all the infrastructure? So you're moving from net metering to net billing. You look at that and you say, but that really doesn't save me a lot. Well, there is one thing that you can do now. Instead of just solar panels, you would attach a battery to it. And this is where the argument comes in, where I live in Costa Rica as well, is that you can charge your battery at night and run your house during the day so that you can arbitrage between the rates. Yes, you will still pay the utility, but that doesn't mean you have to pay the same rate at each kilowatt hour. So you have more solar being installed with batteries attached. That's going to mean something a little later on. Let's look at the federal level, going from the state level. You get the idea from the state level that because of the shift in the type of compensation, solar doesn't make sense on its own anymore. It's solar plus battery. And we're going to see that Sunrun has shifted to that as well, a battery-first strategy, that about 70% of their installations are battery attached. Let's look at the federal level. Homeowner credit, Section 25D, gone. As of December 31st, 2025, it is gone. So if you decide, I'm going to put solar panels on my roof and I'm going to put a battery on there, you don't get that credit anymore. You pay full price. So all you have is arbitrage. I'm going to charge my battery at night, run it during the day, and then you have the convenience of a battery backup in case your power goes down. If it's third-party owned, in other words, you want solar panels and a battery, but you're not going to pay for it. Some other company is going to pay for it, and you're going to pay them a certain amount of money per month. There you go. And that will be lower than what you were paying to begin with. And because utility rates tend to only go up, you don't have to worry about, well, what if utility rates go down? I'm paying a higher amount. They tend to only go up. So usually you'll pay this amount per month, and it usually has a small escalator in it as well. And you'll agree to the next 20 years that you'll pay the third-party owner of your panels instead of paying the utility. Well, if it is third-party owned, they still get a credit under Section 48E. That's all the way to December 31st, 2027. So through all of 2026 and all of 2027, the homeowner cannot match the price that a third party can get by installing the panel, and they enter into either a purchase power agreement where they'll pay for the kilowatt hours generated, or a lease. Also, there is foreign entity of concern restrictions. Even if you're a third party, you're Sunrun, you're installing these panels, you still have to say, but I got to avoid these certain countries. Well, right now, a lot of the stuff comes from the very countries I have to avoid. So there's an escalating agreement in there that, hey, 40% has to be sourced from outside of these countries, rising to 50, rising to 60, rising to 70. We're going to give you time, but you can't use Chinese solar panels forever. Come on. Right? Applies to projects starting after December 31st, 2025. So that is now. Requires certification of no components from China, Russia, Iran, North Korea. Threshold start at 40%. In 2026, and then they rise from there. Let's look at what we have down here. This is what I was talking about with a battery, is that you can then say, well, why don't I charge my battery during super off-peak hours where it might be as low as 10 cents per kilowatt hour, and then I'll use it when it could be as high as 60 cents per kilowatt hour. Where I am in Canada, in Font Hill, my highest rate is about 26 cents per kilowatt hour. It's all hydro. Niagara Falls powers everything here. And then if I charge off peak, it's about 10 cents per kilowatt hour. So I have about 16 cents per kilowatt hour arbitrage. Doesn't really justify solar panels and a battery. Doesn't do it. But a battery pack could do it, because we do have lots of outages here. If you were going to buy a generator outside to run your house during the power outages, you're going to spend about $5,000 to $6,000 anyway. So you may as well spend $15,000 on a power wall. And you can at least arbitrage 16 cents. But in some states, it is a big difference, like California. You could be charging at 10 cents and using that electricity at 60 cents. That 50 cents is a big arb opportunity. So storage, really solar on its own, doesn't make a lot of sense unless you have storage. What's going to happen over here? After 2027, you may be looking at these companies saying, well, you can't value them as a 20-year or 30-year company. If in 2 years this tax credit just goes away, the amount of installations are going to drop significantly, aren't they? Well, this gives them 2 years. And the question has come up is, how are you going to offset the investment tax credit? When you get the investment tax credit, the Sunrun's calculation is it will drop their net present value on systems by about $6,200 per system. That's a big hit post 2027. So they're looking at offsets, beginning to say, well, let's source some lower cost equipment. What about reducing our customer acquisition costs? We're going to see that they're really high. Get an idea in your head of what a customer acquisition cost would be for rooftop solar. You're going to be surprised when you see how high that number is. Tesla has the biggest advantage in customer acquisition costs, because if you own a Tesla, they have an in right away because you already have the brand name. But Sunrun doesn't have that, so their customer acquisition costs are very high. Expanding grid services revenue. We're going to see when we start talking about not just time of use, but virtual power plants. When you have this many distributed batteries, you have a whole bunch of capacity, 2-hour capacity that you can bring online. That is valuable for utilities. And also raising the PPA prices to offset this as well. So that's the purchase power agreement. So you can lease one of these. They put the solar panels and battery on your house, and you can lease it, which means you're going to pay a certain amount per month, let's say $120 or $180 a month for the next so many years, increasing at a certain amount. Or it's a purchase power agreement, which means if the system produces a whole bunch of kilowatt hours, you pay for everything it produces. And if it produces more than you use, what you sell back to the utility is yours. And in winter months, it produces less, so your bills would be high in the summer, low in the winter. And when they're high in the summer, let's say that you use this much. When they're high in the summer, you take this excess and you sell it. And when it's low in the winter, that means you're buying from the utility. You could do it as a purchasing power agreement or as a lease, so you could just raise the PPA prices to offset the 62. So lower cost equipment, reducing our customer acquisition cost. What about expanding grid services revenue in the future? And we can always raise our PPA prices to offset the 62. So it's not as if the world just falls apart on January 1st, 2028. Now you could say, well, there could be some legislation that extends all of these things. This is still sort of speculative on that. You would have to wait for potentially a new administration, a new Congress that then looks at this and says, yeah, let's continue this on. I don't know that I would bet on that. Okay, let's look at some financial metrics. When we look at companies like Sunrun, they are better classified as specialty finance. I had a hard time figuring out where to put the PDF for understanding residential solar, because it's kind of utility-like, but it's not a utility. It is very financial. It's almost like a REIT, but it's not really a REIT. So I had a hard time figuring out where to put it. I put it in the utility section because that seemed to make the most sense based on the nature of the business that the assets are doing, but this is not an income statement company. This is a balance sheet company, so we have to have different ways of valuing it, and we need different language. You're going to see a bunch of different language in here: SV, subscriber value, contracted subscriber value, renewal value, creation cost, net subscriber value, and contracted net subscriber value. We have to think in terms of that. Also, net earning assets as opposed to net asset value. Why do we not care about the income statement? Is all of the costs of putting that solar on your rooftop. All of the costs are incurred right now, but the revenue's over the next 20 years. So the income statement, if you're a growing company, is going to show loss after loss after loss. Now this sets up a bit of a problem. I get investment tax credits and I get accelerated depreciation on the equipment, but it's only valuable to me if I have income. If I'm a growing company, I'm going to have net losses. It's not valuable to me at all. What am I going to do with that? And it's important because we have to understand the capital structure of these companies and why they use so many partnerships. You need a tax equity partnership if you're going to monetize some of these tax benefits. So we're going to have to understand what that means. So when we look at these things, we're going to see a lot of adjustments for non-controlling interests. And these partnerships usually flip after about 5 or 6 years. They flip over such that Sunrun now becomes the big owner of it. But initially, they have a very small exposure to it. So this is why we don't really pay too much attention to the income statement. You're going to look at losses. You're going to look at the balance sheet. You're going to see under retained earnings a huge negative number. Well, yeah, that's just the nature of what this does. We have to have different metrics to measure this by because of the mismatch between your expenses, who gets the tax benefit, and the cash flow. So here it is right here. We have to look more, instead of profit created, we have to start looking for where is the economic value created. You have long-term contracted revenue. You also have tax benefits. However, given that you run reported losses, these tax benefits are useless to you. So you have to find some way to monetize that as well. And here are some of the metrics that you have to get comfortable with. And we're going to look at Sunrun's Q3 investor presentation, and you're going to see these words everywhere, and you're going to see the calculation of these. And then you know, if you were looking at it first going, I don't understand what's going on, well, this is what this is. Your subscriber value. This is the present value of expected cash flows, contract, whatever the contract term is, plus whatever expected renewal there is. The life of the assets are 30 years. You sign a 20-year contract. There is some assumptions in there about the rate of renewal. How many of these homes are just going to say, you know what, let's just go another 10 years, as opposed to after 20 saying, okay, you know what, come and get your stuff, I don't want it. Less all the servicing costs. Contracted subscriber value doesn't include any assumptions about renewal. It says you signed a 20-year, it's a 20-year. Yeah, maybe you'll extend for 5 or 10, but we're not going to count that. It's just the contracted subscriber value. Renewal value, the behavioral assumptions, these are absent from the contracted subscriber value. And then you have creation costs. Well, I got to buy all the solar panels. I got to buy the battery. I got to install it on your roof. I got to pay people for that. Those are the costs to create that contract. This contracted subscriber value, I got to pay commission on the salesperson. All of that stuff I got to pay. I take my contracted subscriber value minus my creation costs. I get net subscriber value, or contracted net subscriber value. So SV minus my CC will give me NSV, and contracted, the CSV minus CC will give me the contracted net service value. So there's net service value and contracted net service value. This is what we have to look at. We're saying here the present value expected cash flows. Well, we got to do a discount rate. And there's a big argument about, well, what discount rate that you use. The lower the discount rate, the more economic value you create. The higher the discount rate, the lower the economic value you create. What are you going to use? There is a good argument for using a lower discount rate. Sunrun uses 6%. and their argument is along the lines that these are ABSs. They're highly rated. It's non-recourse debt. It does not come back to the company. It survives on the strength of the assets themselves. You understand what mortgage-backed securities and asset-backed securities are. You set up an SPV. The assets belong to the SPV because there is an interest that Sunrun has. They have to consolidate everything, so it looks like they have a lot of debt, but a lot of it is non-recourse debt. So because it's non-recourse, it's like it doesn't affect us. It doesn't really matter. It should reflect the price at which the market is willing to buy the asset-backed securities at. The other side of the argument is, yes, but you hold an equity portion of this. The equity portion absorbs the losses first. You're going to have losses because defaults are about 1% a year. You're going to have losses, which means 6%. Doesn't reflect the equity. And it's the equity that you hold. But to value the whole amount at the equity value doesn't make sense. And it doesn't really make sense to value the whole thing at the 6%. But we can make a small adjustment. We could say, let's value it at 6%. Let's figure out what our net earning assets are. And from there, we'll take a discount off of that to reflect defaults, which is what we're going to do. So let's look at some of the numbers we have. Sunrun assumes 30-year assets, also assumes 90% renewal. It does sign 20, 25, and 30-year contracts. When it signs a 25-year contract, it assumes 90% of them will renew for the next 5 years. When it signs a 20, it assumes 90% will renew for the next 10 years. That's untested. Personally, I think that's a little bit high, so I don't know that we would tend to use SV. We would use CSV. However, when we do this, they get to $52,400. That is battery, a lot more battery attached to that. So that is a big jump, 11% year over year. But the jump is mostly because more and more installations have batteries. 52,400 contracted, right? This is CSV now. Contracted is 48.5. This is the legally enforceable obligation only. Creation costs of 39,200. So you get the spread between 48.5 and 39.2. Net service subscriber value, taking the 52 minus the 39, you get the 13.2. Contracted net, you get to 92. This is up 38% year over year. This is up 36% year over year. Your creation costs are only up 4% year over year. Only up 4%. So your net subscriber value and contracted net subscriber value up significantly. Good cost control in there. Let's go to some results from Q3 2025. The sum of all subscriber value. This is what they get for subscriber value per subscriber multiplied by the number of subscribers, generated $1.6 billion in subscriber value, up 10% year over year. Contracted, the sum of all the contracted net service value, $279 million, up 35% year over year. For Q4, for the sum of service value. Big jump here. Let me just be clear. This is contracted service value. That is the sum of all of these. This is contracted net service value, which means we are taking creation costs up and coming up with this 9,200 multiplied by, you get 279 million, up 35%. For Q4, for subscriber value, they're guiding, look at the big range, 1.33 to 1.63, down 5% year over year. But on the net, 182 to 482. Again, these what I said earlier, right? These big, from the lower to the upper bound, these big ranges, up 6% year over year. So even though this is down 5, up 6%. Cash generation, anywhere from 60 million to 260 million. We say cash generation. This is not cash from operations. It is cash from all sources because they do put a whole bunch of these on rooftops and then they securitize them. So that is part of their business model. The securitization is part of operations, but it ends up in the financing section of the cash flow statement. So we have to look at cash flow as a whole. Cash generation, 60 million to 260 million. That's a big difference, right? That's why they have such high volatilities, because their guidance is so wide. Discount rate, to get to these numbers here, the service value, subscriber value, and the contracted net subscriber value using a discount rate of 7.3%, securitization rate of 6.21%. Nice little spread in there, right? Their current price, 1954. We're going to see this a little bit more, the 1456. What's the 1456? This is the portfolio value that if they stopped right now and you owned the balance sheet, and all of the cash flows coming in, and you took all of that cash flow and you paid off all of the debt, you would end up with $14.56 per share on a present value basis. That is the value of their portfolio. However, look what they did in Q3. Another $279 million. That's $1.21 a share. So every quarter they're adding about $1.21 a share onto this number, onto their portfolio value. Well, what multiple would you give that? Well, if this is $1.21 a share over a quarter, let's multiply that by 4. The difference between their current price minus the portfolio they have right now is $4.98 divided by this number. At the current price, you're paying a multiple of 1 for the platform. This is starting as sum of parts. We have the portfolio of assets that we can buy. We also have the platform. The platform is the business itself that generates more of the portfolio. Only a multiple of 1. But they have an equity position, right? They suffer losses first, and losses they will have. So let's say that they'll suffer up to 20% of this. This would bring this down to about $11.66. And if you add the $4.84, you get to around $16, which is a little lower than we are right now. We're at 1954. However, we're going to see on a bear case for the multiple, 2 to 3 is a bear case. 1 is we don't want this shit at all. So, net earning assets. We see this over here. This is the equivalent of looking at a REIT and saying what is its net asset value. Net earning assets in March 31st was 2.6 billion or 11.36 a share. 6 months later, 3.4 billion. This is September 30th, 14.56 a share, because it increased by $1.21 in the quarter. So if we have the fourth quarter increases by $1, call it $1.20 again, will be somewhere around 15.76 for the portfolio, and then you would add to that some multiple of the platform. Okay, let's see if we can understand our capital structure. We have 4 components. Tax equity partnerships. I'll explain what that looks like in a second. On top of or below that is non-recourse debt. Non-recourse debt is all of the asset-backed securities that you sold. All of those assets belong to SPVs, but they're consolidated. Then you have recourse debt and common equity. Every business has this, right? So you'll understand recourse debt and common equity. Recourse debt is whatever bonds you took out, whatever bank loans you have, whatever accounts payable you have, and things like that. But these companies have this non-recourse and tax equity on there, which really isn't, the non-recourse debt isn't really their debt. The assets that they list are there to pay that debt. Let's deal with the tax equity part first. Remember now that these companies are running at a loss. So they can't really use a lot of these tax credits. You have accelerated depreciation. Yay, I'm already running at a loss though. So you want to enter into a partnership where the partner can use the benefits of the loss. So your tax equity partners tend to be large banks, insurance companies, and corporations with substantial tax liabilities. And how it works is fairly simple. You'll set up a partnership. And under a partnership, the income or the loss of the partnership flows through to the partners. And the tax partner will get 99% ownership, and Sunrun will get 1% ownership, such that all of the losses pretty much flow through to the partner, who can then use it to offset their tax liability. In exchange for that, they'll put up somewhere between 30 to 40% of the capital that's needed to put together a whole bunch of these assets that can then be securitized at some future point. The most common form of this partnership is the flip. And this is what will happen. And then somewhere around 5 to 6 years later, it flips such that it goes down to 99% and 1%. And it usually flips once the tax partner hits some internal rate of return target, like 6 to 8%. Then it flips, and the tax partner still has like 1%. However, there's always an option to buy out that partner, and usually it's exercised because reporting it continually just has a cost. About 6 months later, the solar company will typically exercise the option to purchase the remaining interest. And this is done because the tax credit would simply just disappear. Otherwise, it would be worthless. So to monetize that, all of the tax benefits, you need a tax equity partner. There are very few of these tax equity partners, maybe about 20 of them overall. It is difficult to set up the paperwork for this stuff because you have to satisfy the IRS that you're not just avoiding taxes. Right? There is the letter of the law and there's the spirit of the law. So it has to be set up in a very particular way, while these guys already have all of that done. Don't try to do it on your own. So you're going to have to try to find one of these tax equity partners. So that is a barrier to entry right away. If you already have a solid name in the industry that you are doing business with these, that is important, and Sunrun already has that. Another way to do it is the T-flip structure, where the accelerated depreciation, you're still going to need a tax equity partner. However, the legislation allows you to sell your investment tax credit on its own to somebody else. So Sunrun can sell the investment tax credit. Let's say it's $7,000 or $9,000. They can sell that investment tax credit to somebody else. But they can't do anything about the accelerated depreciation. It doesn't help them, so they enter into a tax equity partnership with that. So they have all of these partnerships. Now, you can see that, in the beginning, because they only own like 1%, they're not consolidating this. So this is going to be under their assets, if you think about the equity method of reporting this asset, that's probably where it's going to be hidden in there. When we look at the presentation, page 17, 2030 convertible notes that were now on the recourse debt, they have $483 million due in 2030. Working capital facility, $319 million. 2026 convertible notes, only $5 million in debt ahead of them this year. Recourse debt, $808 million. They have over $14 billion in debt. A lot of it is this non-recourse debt. So they'll set up an SPV, and they'll transfer all of these solar assets to the SPV, and they'll sell bonds against it. And they usually have two tiers. They'll have a tier, a tier that's rated A+, so that they could sell it to institutional investors, and then a lower rated tier. And then they hold the lower rated tier, and they'll get advance rates of somewhere around 80%, meaning if they're trying to securitize $100 million of solar assets, they'll get $80 million from that, and they're holding the balance. They take the first set of losses, so they can lose up to 20%, which is why when we look at the 1426, I say, let's just take off the 20%. Let's assume they lose it all, right? Really bear case scenario. We're going to see when we do some of the parts. If you take just the worst case scenario, the price you would pay now for Sunrun at $19.50 is fair value for the worst case scenario. Wow. If anything better than worst case scenario happens, then this stock is undervalued. So because you're securitizing, you're initiating the debt, you're originating the debt, and after you have enough of these, you securitize them, you're recycling your capital. So you install all of these solar panels. You're going to use some warehousing funding facility to get it done, because you've got to hold it on your balance sheet while you're waiting to get enough of these to securitize. And it's not a matter of getting enough of them. You have to have enough a portfolio that represents a good broad range of credit ratings and geographical exposure. You can't just have it all, this is all just California. San Bernardino, here you go. It's got to have a good geographical diversification in it as well. The lower the effective federal funds rate, the lower the cost of warehouse facility is. You accumulate volume, you wait until they build up on your balance sheet, you securitize them, you get the capital, you do it again. And you just keep following this capital recycle. So lower rates and lower yields, lower warehouse, this is working capital, lower warehouse finance costs, lower securitization yields, which means that instead of having to sell bonds and pay like 6.21% interest on it, you can sell bonds and pay 5.5%, 5%, 4.5%. Higher present values because your discount rate would drop as well. So you would have a higher value of net earning assets, which means the portfolio value of your company increases. So what I've talked about so far, the value of their portfolio, the net earning assets, plus the value of their platform, the ability to continually generating these net earning assets, these are two components of some of the parts. There are other sources of revenue as well. One coming from virtual power plants, another one from different grid services that you could potentially sell. Let's understand this virtual power plant business. Run has the largest home-to-grid virtual power plant. If you have battery storage dispersed in a state, in a bunch of different, or even just let's say a service region, you have all of these batteries within the service region, and the utility is saying, okay, well, we need to bring more power online. What you can do is collectively, all of these batteries can start pushing their power out to the grid, and that would lower the demand for the grid. It doesn't matter, where it comes into the grid. As long as it comes into the grid, it doesn't have to come in from one point. But a command is issued to all these batteries to start dispersing energy right away. Well, having this ready right away has value for the utility because they do have a source that they can call upon. So right away, Sunrun would get something called a capacity payment. That means that just because you're offering it, I'll give you some money, just so that I can call upon you and say, okay, now. But you can't say no when I call you because I'm paying you for that capacity. So you get these capacity payments, and then you can discharge these batteries, and then Sunrun does credit back to the household some of the money that they get from that. So if you put a battery in place, so let's say Sunrun installs a solar panel on the battery, you don't pay anything, they pay everything, and say, would you like to enroll in this virtual power plant? If you do, we'll give you $200 a year for the next 20 years. That's $4,000. What do you say? Now if it's a lease, well, then they'll do what they want. But if it's a purchasing power agreement and you're paying for every kilowatt hour that's being produced, whether you use it or not, meaning you're selling some back to the grid, you would say $4,000. That's pretty good. So you sign up. Well, you wouldn't be alone. 106,000 customers. That's a 400% increase year over year. When a customer signs up, Sunrun estimates that it adds about $2,000 to that subscriber value in net present value per customer. It adds $2,000 by subscribing them. 70% of new customers have storage, so there's lots of capacity to sign them up, but not everybody agrees to sign up. They expect to have 10 gigawatts of capacity under these programs by the end of 2028. They currently have 3.7 gigawatts of capacity. They want to have 10 gigawatts. 106,000 customers are enrolled, but they have 217,000 systems installed already, so they do have some internal growth that they can get. 17 active programs, because of course it has to be per region, so they have 17 active programs. They delivered not just the capacity. They get paid just to say we're going to deliver it, but then you do it. Sometimes have to deliver it. They delivered 416 megawatts in 2024 alone. We don't have Q4 of 2025, so we don't know the number there. If you go through their statements, they don't disclose separately what the grid services revenue is, so it's hard to begin to value that. So when we do some of the parts, I'm going to put a zero value on it. I'm just say, I don't know, let's put a zero value. But it falls under a part called optionality, the different optionalities that you can have just by having this. Estimate is about 25 based on the number of customers that are enrolled, based on the range of money that each customer can make. There's an estimate somewhere between 25 and 45 million per year in revenue on this one. Department of Energy, a 2030 projection for virtual power plant capacity, 80 to 160 gigawatts by 2030, and their target is to get to 10 gigawatts by 2028, considering the size of the overall market that the Department of Energy is estimating. It doesn't look that unrealistic. Okay, let's have a look at valuation approaches. Sum of the parts framework is basically the approach to take on this one. Comparable transactions is tough. There just aren't that many comparable transactions, and when there are, it's usually in distress, or at least the ones that we can find are usually in distress, so it doesn't help us there. So let's just start with some of the parts. The first one, existing contracted cash flows, gives us a floor value. On that, we will add value creation from new originations. So this is your portfolio, how much you would pay for the portfolio that exists on your balance sheet now. This is the platform, how much would you pay for the company that generates the additions to the portfolio. And this is optionality from new businesses like grid services, virtual power plants. Now we know they're generating money from that. They have active programs. But we're going to put a 0 on optionality for now. And we're just going to value the portfolio on the platform. Sunrun's investor presentation gives us a whole bunch of calculations for this and a whole bunch of sensitivities. We're going to have a look at it. We're not going to go slide by slide. I'm just going to show you where it is and what you can get out of it. So if you're interested in going further, it gives you a whole bunch of the language that we've just talked about. Page 16, this is where we find our contracted net earning assets, $3.4 billion. On top of that, you have non-contracted earning assets, $4.9 billion. Remember, this is just contracted. This assumes some renewal in there as well. So total of $8.2 billion, 8.2, but we're only using what is contracted. In other words, for the portfolio, there is no assumption based on any kind of renewal. Just the contracted net earning assets, $14.56. But Sunrun does have the equity position in these asset-backed securities. So we can assume, well, what if you lose all your 20%? Because they do have advance rates anywhere from 70 to 85%, say 80% on average. An advance rate is you sell 100 million or you sell bonds against 100 million in solar assets, you'll get 80 million. So you retain the 20%. So if you take the 20% out, you'd lose about $2.90, call it $3 a share off the floor. And that's assuming total collapse of the equity portion. If we took the total of $8.2 billion, we get to $35.58 a share. I don't know that that's very helpful to look at. Your calculation of these numbers is on page 26 of the presentation. Sensitivities on page 27. So for the portfolio, let's just go to the 1456. We're not going to take any of the non-contracted. Clearly, we're going to get some of that. And we're going to assume that we have defaults, but we're not going to have 20% defaults. So maybe these tend to offset each other to some degree. Let's work with the 1456. Platform, page 14. This is where we get our contracted subscriber value minus our creation costs. For Q1 to Q3, 800, 818.20. This is millions divided by the number of shares. That's 355 per share, 473 on an annualized run rate. On earlier, I used 484 for an annualized run rate. If we just use, and we're growing each year, I should just use the last quarter multiplied by 4 with some growth component to it, but I'm just using 473. Trying to be as conservative as I possibly can. Now, on the low side for a multiple of a platform multiple, in a bear case, you'd get 2 or 3 times the multiple. So take the middle 2.5, multiply the 473 by 2.5. You get $11.83 that you would pay for the business. So that if you said, okay, well, I'll buy your assets, I'll buy your portfolio of existing assets, But you do have a business that generates more because you have all these tax equity partnership relationships. You already have a lot of experience in asset-backed securities. You do have the ability to get A-rated securities out there. You do have a team of installers and salespeople that are generating rooftop sales and housing sales. So that's worth something. So 2.5 times 11.83 on top of the 14.86, you get to $26.39 a share. They're at $19.54 a share right now. And even if you say, well, I'm not going to give you anything for this, and they're going to lose the full 20%, take $3 off, you're at $23.39. They're still at $19.54. And you're making really bearish assumptions. You're saying 473 with no growth and a really bearish multiple of 2.5. And I'm not giving you anything for the non-contracted side, and you're going to lose all of the 20% that you have. I still get to $23.39. So this is a sort of undervalued. If you go to the high end, 8 to 10 times, which you would only get there if you have a yield curve that is significantly lower than what it was. You'd need a 2019 style yield curve where your short rate is under 1%, your 10 years under 2%. You need a very flat curve and really low yields. Then maybe I'd go to 8 to 10. Also, you better give me a regulatory environment that's very friendly. Lots of investment tax credits in here. I don't think we have that. I'd be unwilling to go to here, but if you took the middle of this at 9, you get the 42.56 on the platform, 14.56 on the portfolio, you get the 57.13. I'm not there. I am certainly not there, but I'm not at 1954. I'm somewhat higher than 1954, and again, even going absolutely bearish on everything, I get to 23.39. So I would seem to think if I put a 30 in there as a kind of a target, I'd feel comfortable with that. I've given nothing to the optionality. Virtual power plant capacity, I've given nothing. Any evolving grid services, I've given nothing. Any EV charging infrastructure, I give nothing. Because they do have all the battery capacity to get that done. I give nothing to any kind of optionality. So when we look at this, I'm not doing anything here. I am taking the full 20% off the equity amount over here and giving a bearish multiple on this. I get to $23.39. It's easy to see how I've been making money on this, just selling puts, just saying, listen, if it drops to this price, I'll buy it. So I engineer the puts such that the premium that I get gets me a price of low 17s or below 17. But I think it is time for me to load up a little bit more on this. The next time I have the ability to sell puts, I'll probably move it up to the $20 when it's at the lower end of the range, just because of the sheer level of implied volatility on this. I will look at 60 day options, not the regular 30 to 45 day, but 60-day options at the $20 strike, and I'll probably go with 500 instead of just 50. Yes, that is 50,000 shares. I'd probably go with 500 of them, because after walking through all of this, after being really bearish on the sum of the parts, I still get to a company that at $19.54 is undervalued. And again, let me stress, I'm assuming that 20%, that 20% equity position on average that they're holding gets completely wiped out. Let's look at their investor presentation now. Okay, so here we are. This was third quarter, November 6th, 2025, first week of November. We can expect Q4 first week of February. So we do have that coming up. I'm not going to go through every slide, but you should be able to recognize the language now. Aggregate subscriber value, 1.6 billion, 279 million. Contracted net value creation, $1.21 per share. Contracted net earning assets, this is contracted, 3.4 billion, 14.56 per share, which includes 709 million of unrestricted cash. They also have another 600 million of restricted cash, if you want to throw that on there as well. This is their version. If you were looking at a REIT, you'd be looking at net asset value per share. This is their version of net asset value per share. Cash generation. 108 million in Q3 of 2025. Don't look at cash flow from operations. It's not going to show much. Remember, this is a balance sheet company. Securitization is an operating activity, but that's going to be in the financing section. So you have to look at cash flow generation for everything, the whole cash flow statement, not just operations. Continued strong margin execution, upfront net subscriber value exceeding 3,500, 7% margin, expanding 5 points year over year. U.S. power demand expected to increase. Electricity demand forecasted to increase 40% by 2040, necessitating more than 1,000 gigawatts of new capacity. This is where we are now. Look at the future. It's going to have to include solar. To a fairly large degree, and rooftop solar, residential solar is like, I think it's like 10 or 15% of the overall solar market. It is quite small, but the amount of real estate available, all those rooftops, nation's largest home-to-grid distributed power plant operator providing critical utility scale services, 17 active programs, 416 megawatts of power delivered, over 106,000 customers. Massive opportunity for continued expansion. Their network storage capacity is 3.7 gigawatts. They want to hit 10 gigawatts over the next 26, 27, 28, 3 years. 217,000 solar and storage systems already installed, only 106 of them enrolled. Leading share of installations, Sunrun storage installation, a 42% share in the second quarter of 2025. Solar install volume share, 21%. Let's get to some interesting things here that we should be able to recognize. Subscriber value. There are the components of subscriber value. Contracted versus non-contracted or upside. So the dark blue is contracted, 52,000. We saw this. Creation costs. This is what it costs to get one of these subscribers. Take one minus the other, you get net subscriber value. Net value creation increased to 398 million in Q3, representing $1.72 per share. Net value creation. Now this is overall. This is also including the non-contracted. What I gave you, the 279 million, the 121 per share, that is just contracted. Keep in mind, all of the numbers we're using is saying, look, what do you have for sure on the books that's contracted, that is defensible in court, backed by a contract? I gave nothing to the upside, zero to the upside. Well, you're going to have some renewals. I just don't know if I'm at the 90% renewal rate that Sunrun would be, because keep in mind, you put a 20-year contract in place, you put solar panels and battery on my house in 2026, there is no way that technology is going to compete with what's available in 2046. So why would I renew? There's no way it's going to compete. So I have much lower renewal rates in my head, if I were going to have some, than 90%. Because I only relied on contracted, what do you think my renewal rate is? 0%. 0%. Well, they're going to have something. I just don't think they're going to have 90%. Contracted net value creation. And they break it down for you very nicely if you really want to go deeply in it. This is this 278.9. That's what I was looking at over here. And it gives you the components to it, how they calculated that. There's their discount rate, 7.3. You can see how it's evolved since the third quarter of 2024. They used a discount rate of 7.1. The discount rate is now higher, 7.3. Upfront net value creation of 106 million in Q3. There's the aggregated contractor subscriber value, your advance rate. This is the upfront proceeds times your advance rate. You have tax equity, which gives you like 30-40%. You have your asset-backed contributions as well, and payments and upfront incentives, proceeds from sale of subscribers, non-retained or partially retained subscribers. Then you get to your cash generation at the end. Net earning assets now at 8.2 billion. I only use this, the 3.4 billion, but you can see the progression here from the third quarter of 2024. Excuse me, 10.78 per share, all the way to 14.56 per share. You've had 3 quarters of growth. 3.4 billion. The 4.9 is non-contractor upside net earning assets, another 4.9 billion to 8.2, 35.58 per share. I didn't use that. I just used the contracted. Generating cash and paying down recourse debt, that's what you want to see it do. You want it to pay down the recourse debt. The non-recourse, it's not its debt. So this is the components of its non-recourse debt. Convertible notes 2030, you don't have to worry about that till 2030. Working capital facility, the lower the effective federal funds rate, the cheaper that gets. And then you have just $5 million in convertible notes due in 2026. Here are their partners for their tax equity side. Guidance and outlook. And then you got a whole bunch of, let's just go past this stuff over here, down here. Here's sensitivities for a bunch of stuff. Contracted gross earnings, non-contracted or upside gross earnings, gross earning assets, and at different discount rates and at different default rates. We don't need that. There's a bunch of other stuff in here that we can look at. Statement, we don't need that. It gives you nice descriptions of each line item as well. So if you want to know more about this company, I would dig into this. And there you go. There is the presentation. You should understand everything that we looked at, and you should have a clear understanding right now. This is not a rooftop solar business. This is a specialty financing business whose asset is rooftop solar installations with battery packs. That is the asset by which it then generates its specialty financing business. But it is a balance sheet company, not so much an income statement company. And that's Sunrun.